Hello, everyone. Welcome back to Economics Matters, the podcast. I'm delighted to have David Levey talk about U.S. solvency, fiscal sustainability. David is in the perfect position to speak about this because he's he's a member of the tribe, which is saying that he's an economist. He's a fellow economist. He went, not just a fellow economist, he went to Harvard University for his MA and University of Chicago for his BA, both in economics. And then he lectured at Yale in economics and the New School for Social Research. And then he wrote for Business Week magazine, senior economics writer. And then was an assistant professor of social sciences at Wayne State University. Then he became an independent consultant, corporate trainer, worked with clients including Citibank, Bank of America, Wells Fargo, Shell International. Then he became a manager of country risk for Wells Fargo Bank. And then it keeps going, but he then landed at Moody's Investor Service in 1985. He was a senior analyst there for a couple of years, and then he became, in 1986, for the next 19 or so years, he became the managing director of Global Sovereign Credit Rating. So David was responsible for rating U.S. Treasuries. And if you're familiar with what's happened of late, you'll know that in May, Moody's, David, of course, retired from Moody's back in 2004, but he's kept abreast of everything going on. But his partner in doing sovereign credit ratings, who's taken over since then, they rated down the U.S. Treasury bond and bills, U.S. Treasuries by, I guess, one notch. So we're no longer an AAA rated sovereign debt, a country with a sovereign debt that's rated AAA by Moody's. The other rating companies, S&P and Fitch, had already rated down the U.S. to the same place that Moody's came to, and we're gonna talk about that. But I want David. First of all, I want to say thanks, David, for coming on, and
Pleasure.
And point out that to everybody that you have a Substack column. It's David Levey at substack.com, right?
David H. Levey.
David H. Levey at something. So people can follow and subscribe to your Substack. And this is how I, came across your commentary on the recent downgrading of U.S. debt. But give us some background before we get into this, U.S. fiscal sustainability. Give us some background about how you went from, a 6-pounder to your career. I mean, how did that proceed? How did you decide to get into economics and then into this other area of work?
Well, thanks, Larry, for having me on. It's a great pleasure. Let me give you a very quick biography, because as you mentioned, my career had sort of many twists and turns. It wasn't just a straight shot in any one direction. I grew up in Detroit, Michigan. I'm a Midwesterner. I went to undergraduate school at the University of Chicago. Was very fortunate in my senior year that I got to take graduate courses, including Milton Friedman's legendary price theory course, and also courses from some of the other notable Chicago economists. And that eventually had a great influence on me. But I did go to graduate school at Harvard. I wanted to see another part of the country. So I went to Harvard and got a full dose of Keynesianism, as you yourself know, having also been there about a decade later. So after Harvard, I thought I'd have a conventional academic career, got a job at Yale. Without having time to talk about it, I have to mention, though, to be in all honesty, that I did a detour through Marxism. I was actually a Marxist economist for a while, and in fact, at Yale, Jim Tobin let me teach a seminar on the first volume of Das Kapital, which was unprecedented in U.S. economic teaching at that time. But I abandoned that after a few years. I think a lot of it was connected with the Vietnam War, which I was very actively opposed to. But I abandoned Marxism and I came back to my Chicago roots after, which I've really remained with ever since. So even till today, I consider myself what you'd call a classical liberal. I worked for a while, as you mentioned, at Business Week magazine. That was very exciting. I got to meet people like Alan Greenspan and others, and wrote a story on the OPEC oil crisis in 1973. And then I started consulting, as you mentioned, for various international banks who were just at that time themselves starting to lend actively in Latin America and elsewhere. So they were getting their feet wet internationally, and they needed somebody to give them an idea of how to evaluate, especially the political side of the risks they were taking on. So that was my function. And I ended up, as a result of that, working for 3 years out in California for Wells Fargo Bank as the director of their country risk department. And then in 1985, when Wells Fargo, having been very badly burned in Latin America, I think lost a lot of money when the Latin American debt crisis came along, they closed that department down. And fortunately for me, Moody's, one of the, at that time, two big credit rating agencies, was just starting a dedicated department for sovereign risk. And that fit my qualifications very well. So off we went from San Francisco to New York, and I started at Moody's. And as you mentioned, about a year after starting, I became the managing director of the group. What might interest your listeners is to know that when I started, there were only 12 countries in the entire world that had ratings. 7 in Europe, two in North America, and I think 3 in Asia. Japan, Australia, New Zealand. So it was a very limited group. That changed when, first of all, I don't know if you remember this, a lot of the bank debt that banks had taken on in various countries was converted to bonds under something known as the Brady Plan, being the Treasury Secretary at that time. So countries that were now issuing bonds needed credit ratings. That's a conventional requirement in the bond markets. So as they started to issue bonds, they needed credit ratings and started to come to us. We also sort of broke new ground by rating some countries without their request. Even if they didn't want to talk to us, we felt we had enough publicly available information from sources like the IMF and the World Bank and others to go ahead and rate them anyway. So all in all, and then, then a lot of other things happened. The breakup of the Soviet Union brought a whole bunch of new countries into the picture. The formation of the European Monetary Union brought some of the Mediterranean countries around. Eventually, by the time I retired, there were over 100 countries that we had rated. So it was a dramatic time.
Well, so that's amazing. So let's talk about the recent rate downgrading of the U.S. Treasury and fiscal policy in general. You wrote in your Substack piece that the downgrade was not major, but it is significant. It's a statement. Moody's held off for a long time going there. What do you think? I presume that you agreed with the decision, and you thought the other companies had moved too soon on their downgrading. But at this point, it was proper for Moody's to do this. What's your thinking about the current fiscal position and the trajectory?
Okay, let me just again give a little background. When S&P downgraded, which was in 2011, I actually wrote a piece online saying I didn't agree with them at that time because their reason was essentially the debt ceiling. You know, we have this peculiar
Mhm.
animal in the United States, which is a debt cap, a ceiling on how much debt the United States Treasury can take on. And there was actually the risk that the government would miss some interest payments, or at least have to postpone temporarily some interest payments. And that was on that basis that S&P downgraded. I felt that was not sufficient reason. It wasn't a fundamental change in the position of the United States government as a debtor. It was a technical difficulty which would be overcome with minimal, if any, loss to investors. So and it also at that time, even after the Great Recession, the debt ratios of the United States government were not that high. I mean, we were looking at something in the 30 to 40% debt to GDP range, which was not at all unusual for advanced countries. And so I didn't think that there was yet reason. And even as it built up over subsequent years, it wasn't really until the most recent period that the debt numbers have started to climb very, very significantly. The other factor to keep in mind is that the United States, we have to distinguish between, and Moody's does distinguish, and other agencies do distinguish between the government and the country. This is something people get confused because, of course, we speak loosely about the United States being downgraded. And that's natural. But it isn't the United States as a country that's being downgraded. It's the United States government debt. And there's a major difference there. When Moody's downgraded the government debt to AA1, which is the second step in the rating scale, they kept at AAA what's called the country ceiling. This is the rating which sort of sets a ceiling on the highest rating that any issuer in that country can receive. So there are actually still states and corporations in the United States that have AAA ratings. So it's specifically the government's debt, the federal government's debt, which has been downgraded. And as you mentioned, the main reason for that, above all, is not so much just what has happened, but what we expect to happen. Ratings are forward-looking. That is, the idea is to try, as difficult as it is, to predict the risk of default going out into kind of medium-term time horizon. The investors who use our ratings are holding, a wide spectrum of maturities of bonds. The United States has large amounts of treasury bills, very short term. It has medium-term notes, but then it also has 30-year, 10-year, and 30-year bonds. So we kind of take an average duration and think out maybe 7 or 8 to 10 years. What's the risk of a default in that period? And looking at the trajectory of the debt to GDP ratio and other measures, as you mentioned, that we're going to have to talk about, it looked like the United States was heading into not AAA territory. Now, not that the risk still was very high, because a AA1 is still a very good rating, but it was not as pristine as it used to be. The other thing I just want to mention quickly is that, and this would require a very lengthy discussion, as you know, the United States government benefits from what some people have called exorbitant privilege. The ability to place its bonds at lower cost around the world, because the dollar is the world's reserve currency, because the US Treasury is the main supplier of what economists now call safe assets to investors and especially to central banks all over the world. So the United States finds it easier to place its very large amounts of bonds. We are by far the world's biggest bond market with international investors than any other country. So that that helps. And that has, I think, one of the factors which for a long time has kept the rating higher than it might be if you were looking just at the debt burden itself.
I'd like to talk to you about a really powerful financial planning tool to help you make smart retirement and other critical financial decisions. It's a tool that factors in all your financial data and shows you what you can sustainably spend every year for the rest of your life. That tool is my software company's Maxify Planner. It's incredibly powerful, it's accurate, and it's easy to use. Maxify takes the guesswork out of financial decisions at every stage of life. Its focus is on raising, de-risking, and sustaining your living standard. Maxify lets you run what-if scenarios to see how your finances will change in taking new jobs, buying a home, doing Roth conversions, retiring early, downsizing, investing more in the market, you name it. Knowing the impact of these decisions before you make them is the secret to making smarter decisions. And it's also the secret to what we all seek, which is financial peace of mind. So please visit Maxify.com today to start planning. That's Maxify with an I, Maxify.com, Maxify.com. Now let's get back to the podcast. So, yeah, it's, the US, we're talking about, if the US were borrowing to, let's say the US government were borrowing to invest, either overseas and buy assets overseas, or buy maybe German government bonds, or sell a US Treasury, buy a German Bund, I guess they're called, or if we were investing in high-speed rail, or some other, or even data farms for AI, large language models, that would be one thing. But the US, this is happening, this growth of federal debt as a share of GDP, which is about 120%, I guess now. Depends on how you measure, whether you measure gross debt or debt in the hands of the public. And this is happening, this growth is happening against a backdrop of a US national saving rate, which in 1950 averaged, in the 50s, it averaged 13%, same in the 60s roughly. Today, it's gone downhill gradually through time with some ups and downs, but we're now down at 3% of national income, not of GDP, of national income, which is the right way to measure it. And this connects to who is it that's consuming so much more? Is it the federal government consuming a bigger share of national income? Turns out that's not the case. Their share, for example, defense spending used to be 10% of national income. It's now below 3%. So the federal and state and local government share of their consumption as a share of national income has been roughly constant, 20%. The composition has changed, but the shares stayed the same. The household sector's consumption is going way up. And so when you're running debts, there's a question of what are you using the money for? And if it's to lower taxes, then you're letting particularly older people off the hook from paying taxes, and they get to spend more and then pass away before taxes are raised to pay the interest and principal back on the debt. And so we have been engaging in lots of intergenerational redistribution, taking from young people who are saving for retirement to old people who are dissaving because they know the end is near. So their propensity to save is negative. They're dissaving, and young people are saving. So we're taking from savers to spenders.
Absolutely.
And that's been going on through lots of different channels, including tax cuts, letting taxes, spending go up relative to taxes. That's kind of a tax cut in disguise, but also pay as you go. I call it take as you go Social Security, taking from the young, giving to older people in benefits, Medicare, Medicaid. Most of the Medicaid benefits are going to older people, because of nursing home care. And all these are important programs, but to fund them on the back of young and future generations is not what Thomas Jefferson would have called for, right?
No, you're absolutely right, Larry. In fact, this is where our analysis intersects with the work that you've done over so many years. I mean, you're absolutely right. The borrowing by the United States government is not for investment. It's not for development of future product of capacity. It's for consumption. It's simply a vehicle for transferring, as you said, taxes paid by today's younger generations to the retired, to the elderly. The fact is that if we want to know what is the actual debt of the government, as you pointed out many years ago, there are many different ways to define that, practically an infinite number of ways. It's kind of a semantic convention that we just say this is the government deficit. But the
Right.
government owes, the government has obligations. Other than that, it has obligations to Social Security recipients, it has obligations to Medicare recipients, it has obligations for a whole number of different programs. Are those obligations of exactly the same type? Are they just as hard? That's a question that's been much discussed. I mean, obviously, what you want to know is which of them can, in a sense, can it get out of more easily? Or what is it going to do when the rubber, meets the road? Who's it going to default on? Is the government going to default on the bondholders? Or is it going to announce one day, well, we don't have enough money to pay all the Social Security benefits that you're due? Is it going to be able to raise taxes at any point in the future? You mentioned tax cuts. I mean, one of the interesting facts about the American budget is that the percentage of federal taxes to GDP remains within a very narrow range. I mean, it's usually around 17 to 18% of GDP. It's occasionally been known to very briefly hit 20, but it doesn't change very much. And the major tax cutting episodes that we're all familiar with, from Reagan to Bush to Trump, and so Trump 1 and 2, have mostly just offset the what would have been the increase in taxes that resulted from bracket creep. As nominal income rises, people are pushed into higher brackets, and their taxes would have risen. So there were occasional reductions in rates and introduction of various exemptions and deductions that brought that back down. But at the same time, we were holding taxes at that roughly the constant level of GDP. Spending was increasing dramatically. The spending, not, as you said, for investment, but for redistribution, basically for income redistribution. So now a rating agency has to ask itself, what's going to happen out into the future when the government is, in real trouble, as it might be, as deficits build up the debt, as interest rates perhaps rise even further because investors become more nervous about the likelihood of default, so that the interest that
Right.
the government pays on its debt may also increase. We now know that the forecast, CBO's forecasts, show that interest payments as a percentage of GDP are going to rise substantially.
More
So
than defense spending as a should.
yeah, that's right. They're already more than defense, and then they're going to continue to rise. Every time there's a panic, a little bit of panic at all about government debt, investors are going to demand higher interest rates. Now, you mentioned before the numbers about debt to GDP. If you count just debt held by the public, as they call it, it's about 100% now, of which about 20% is held by the Fed. So, that's an interesting debt problem in itself. The Federal Reserve is holding a lot of treasuries. And foreigners, non-residents of the United States, are holding about a third of that. So we are very heavily dependent on the willingness of investors living in other countries to continue to fund the government.
And that the foreign investment share of the debt holdings has declined, right? From about, hasn't it of late, in recent decades, Chinese, haven't they reduced their holdings of US treasuries or at least,
Well, it's interesting. Everybody thinks about China, but that's a bit of a lag in knowledge. Actually, China is now only the third largest foreign holder, exceeded by both Japan and the UK.
uh,
And actually, the holdings by other European sovereigns and the Middle Eastern oil countries have increased substantially. So
yeah.
China is cutting back, but others are actually increasing, taking China's place. And I think that we don't know exactly. I mean, one of the problems is there's a lot of data problems in all of this. We don't know exactly how much Chinese holdings are because a lot of it's held through custodial accounts in places like Luxembourg and Belgium and Ireland and the UK. So we don't know exactly who holds what. But in any case, we have to keep the goodwill and credibility with foreign investors as well as with our own domestic investors who still have the largest. The largest chunk is still held right here in the United States by pension funds, insurance companies, money market, bond market funds, and individuals. So
The, yeah,
that's the situation we're in, where this number is about 100%, and the CBO forecast says it could easily get to 150%.
and like
This
about
big
20%.
beautiful bill has made things much worse. Now the numbers are getting worse and worse. We know this is going to take it's going to add another $4 or $5 trillion to the government's debt, over the coming period.
Want more money, less risk, and a better life? Buy Money Magic, a new book by Lawrence Kotlikoff, Boston University economist, personal finance expert, and best-selling author. Whether it's education, career, marriage, housing, investing, retirement, Social Security, IRA, or 401k decisions, Money Magic delivers scores of secrets to raise your living standard. Financial journalist Jane Bryant Quinn says Money Magic is a must-read. Nobel laureate George Akerlof says Money Magic is quite probably the best financial advice book ever written. Financial guru John Malden says, you'll love this amazing book. It's full of wit, wisdom, and startling paths to a better financial life. And columnist Scott Burns calls Money Magic a funny, brilliant read, offering wildly powerful, unconventional choices that can literally change your life. Get Lawrence Kotlikoff's Money Magic today at Amazon, Barnes & Noble, and independent booksellers.
I think, yeah, and I think it's important to say, I think the CBO is maybe out to 150% of GDP or by middle of the century, 25 years from now, not that far away for, let's say, a 20-year-old's lifetime. And the this is after we had a significant inflation, 25% cumulative inflation under Biden, that watered down the real value of the debt, so that Biden actually ran surpluses. If you adjust for, if you look at GDP in nominal terms was going up and debt wasn't rising as rapidly.
Right.
So debt to GDP actually was declining for several years under Biden, then it went back at the very end to going back up. But as you said, it's the spending, the revenues are, yes, this big, beautiful bill maintained the tax system as it basically has been since Trump, but it hasn't brought spending down. So
Right.
a lot of people are going to point to this bill as a big tax cut, but it's actually minor to maybe 1-2% relative to what it would otherwise have been to anyone's own tax liability. But the total share of GDP in taxes is roughly staying the same, but the spending is going up in large part because the country's aging. or some part, because it's aging and because our productivity growth is not as high. We have more wage inequality, so fewer people are paying like FICA taxes. Uh, uh, a bigger share of the wage base is not being subject to hit by FICA taxes for Social Security and Medicare because of the ceiling on, at least on FICA, on Social Security FICA tax. There's no ceiling on the Medicare tax. But let me point out one, or kind of respond to this point you were making about the infinite number of measures of debt. So we have as a nation and as even as individuals the ability to take any government uh, transactions, receipts and payments, receipts they collect and payments they make, and say and really label them as we like, so we can uh, put things on the books or keep them off the books. So if I am Uncle Sam and I take some money from you, David, and say, uh, gee, David, that's a Social Security contribution, and I promise to make you benefits in the future. That's not really anything but a choice of words relative to my saying, David, I just borrowed this money from you, and what I'm going to pay you back in the future is principal plus interest,
Right.
plus maybe an old age tax if it doesn't exactly equal principal plus interest, what I'm promising. So that means that we have in economics the same problem that physics has when it comes to defining absolute time and distance, which is that there is no absolute measure of the debt and the deficit.
Relativity. We've got relativity in both.
Yeah. So I wrote a paper with Jerry Green, who you may have run into at Harvard. He's the senior, at least in terms of the oldest theorist at Harvard. We called the paper on the general relativity of fiscal language.
Right.
Showed that no matter what the nature of the economic problem model was, you could have all kinds of problems with the economy that you're modeling, but as long as agents were rational, they weren't confused by language, that deficits and debts and to aggregate taxes and transfers and government saving, government wealth, private wealth, communism, capitalism, none of this stuff was well defined theoretically in economics. And I wrote this paper called Deficit Delusion for a journal that William Kristol's dad was running, called The Public Interest. You're probably familiar with that.
Oh, sure.
So that came out in 1986, a paper called Deficit Delusion. 2 years later, the editors of Science magazine somehow took a look at this and said, well, this sounds like physics. It sounds like relativity. So they had me write a paper in Science. And then I wrote a whole series of things, including this thing with Jerry Green, which we call the general relativity of fiscal language, asking how many economists have actually read this. To write a paper with that kind of rather obnoxious title, we made it obnoxious to not to pretend that we were Einstein, but to get people to read it, because realizing that what you call on the books and off the books is relative to what, it's just a word choice, is not anything that Einstein would have taken more than a half second to figure out. Anyway, one last quick thing to say, which I'm currently doing an update of this fiscal gap alternative methodology of putting everything on the books and looking at whether the government in present value is getting receipts that will cover the present value of all the projected outlays. We're short. I'm doing this study with the Bank of Italy economists comparing the two countries, and it's looking at who's in worse fiscal shape. Turns out the US is in worse long-term fiscal shape on this measure. We need to get about 7.6% of GDP forever in extra taxes or lower spending, apart from interest. That's about a 24% tax hike, or maybe a somewhat smaller spending, immediate and permanent. Okay.
Right.
Today, if you wait, it gets to be a bigger number. Italy, it's more like a 14% problem in terms of tax increases or spending cuts. So their fiscal gap is much smaller share of GDP than ours. They're more like about 4%, we're 7.6%. And the other class thing to say here is if you ask the question, what if you don't do anything to make currently living generations pay anything more on net in the form of higher taxes and lower transfers? What if you leave them out of the picture and dump the whole bill onto the laps of everybody born in the future, next year and thereafter? How big is their lifetime tax rate? If you look at their lifetime taxes as a share of their lifetime labor earnings, what would it amount to for them to close this fiscal gap? Turns out it's well over 100% for both countries. The US, because it's so big to begin with, Italy, because their demographics are so bad and their productivity growth is so low.
Right.
There's not enough people coming along earning enough money in Italy to pay even the smaller fiscal problem, deal with it. So we have no alternative but for current adults just to take a hit and deal with the problem. Do you see that happening, given the
Well,
current?
that's why this is not, I mean, we always understood this is not just an economics problem. This is a political problem. I mean, it's a problem, I guess, to use an old term, it's a problem of political economy. I mean, what is the political system capable of doing? Can we actually arrive at a solution? And if not, I mean, what are the various possible outcomes? I mean, looking ahead, you've calculated how much of that huge gap there is. So how do you close that gap? Well, from the point of view, our interest is in giving a signal to the people holding the bonds. And the signal to the people holding the bonds is essentially, are you going to be the ones taking the hit? Is the hit going to come in the form of an outright default, where the government just says, we can't pay this? Is it going to come in the form of a burst of inflation, which brings down the real value of that debt? Some countries, of course, have solved, quote unquote, this problem through hyperinflation. I mean, are we going to get to that point? Or is the government simply, or is the political system going to be able to either raise taxes on, as you said, on the present generations, or cut the benefits in some way? I mean, you mentioned the demographic pressure. I mean, that's part of it, but it's also, for example, the indexation of Social Security to wages, which was introduced in 1977, I believe, and which has made things considerably worse. It's the various kinds of caps, and the lack of any means testing of Social Security. A certain portion of the benefits are being collected by wealthy people.
Well, we do have taxation of the benefits, right?
Pardon? Yeah, we do have
Yeah,
taxation of benefits, but it's not certainly nowhere near enough.
right.
So the question is, if we used if we used your calculation, I think somebody would very fairly come along and say, well, heavens to Betsy, I mean, the United States is not a AA country. It might even not be an investment grade country, the government, I'm saying. Look at the enormous gap between what it owes in the broadest sense and what it can pay. And that, there would be some validity to that. The reason probably that, the rating agencies still keep the ratings at the level they are is that they believe it is far more likely that taxpayers or benefit receivers are going to take the hit one way or another than that the country would actually default on that the government would default on its bonds. So it's a likelihood game. What's the most likely outcome here? The other problem always to keep in mind is the problem of a run. So, and we know that banks, the title that you gave to this conversation is the U.S. insolvent. And what
Right.
does insolvent mean in this situation? By the calculation you've just given, the answer is yes. I mean, liabilities far outweigh future, future income. Now, future obligations way beyond future income. So in that sense, the government is insolvent. But even before an institution is insolvent, or even before people know that an institution or think that an institution is insolvent, there can still be a run on that institution. I mean, bondholders could say, I want my money. I mean, we have a lot of very short-term debt that we have to roll over. The government has a substantial amount of very short-term debt that it has to constantly roll over. And, one day it could wake up and find that the Treasury auction, nobody's showing up. We've had a few small scares of that sort in the last few years, but that day could come because people have just lost confidence. The government will have lost all of its credibility and investors will lose confidence. So we don't know when this day of reckoning would come. I mean, that's one of the problems with doing ratings. A rating is a kind of average sense of how much risk there is, but there's no way to know
So David,
on which day the hammer will fall.
yeah, so that's actually very interesting. I mean, you're ahead of this rating. You're making this rating decision for the whole country and really the whole world for 19 years. You're one of three people,
Well, no, it's usually a committee.
committee, but
It's a
but in the end,
committee of 10 to 15 people, usually.
probably your opinion is decisive. It's maybe like the Federal Reserve Board of Governors.
Well, that's interesting you should say. It's really not the case. I mean, it's some people don't understand this. Rating committees are made up of all the people who have some relevant knowledge to, to that rating. And they are strictly one person, one vote. I was often outvoted. There's no One thing I liked about it actually was that, being in a managerial position, in fact, people who were above me in the managerial hierarchy who were present at the meeting were often outvoted. So in that sense, it was
I see. That's
a very
interesting.
democratic process. If you had a reason to be there because you were one of the sovereign rating people working on that country, or you were the analyst working on the banks located in that country, or in other words, you had some expertise, you were part of that committee, and it was strictly a majority vote. Anyway, that's just an aside, but I was deeply involved, and who knows if I had more influence than others, I don't know.
So when you're sitting around with, you said 19 people?
Well, no, I'd say more like usually 10 to 15.
10 to 15 people. Are you discussing, this Treasury Secretary seems like a moron.
That
Has
happened
no
occasionally.
economics background. He's pushing he's likely not to take the steps that we need to get things. So he's raising the probability of bigger problems down the road. Is that the kind of thing that comes up, or is it the specific, more the numbers, more the projections of the CBO?
A lot of it is you have to start from the numbers. I mean, that's why to be just again to be a sovereign analyst in those terms, you had to have a grounding to start with in economics. I don't think we had anybody doing this who wasn't fundamentally trained in economics. But you needed also to be, as I said before, a political economist. You had to have a broad view of what people like to call the Overton window. What's the space of political decision making? What's realistic to expect the politicians to be able to do and the voters to let them do on a certain issue? People call Social Security the third rail of American politics for a reason. I mean, we can see even that, the Trump people with Doge and all of their shenanigans wouldn't touch either Social Security or Medicare. They understand, the political limitations. So it's not so much a particular Treasury Secretary because they don't necessarily last that long. I mean, we're looking into the medium term at least, and governments change.
Yeah.
Sometimes in many of the countries we were looking at, governments can change frequently. I mean, there would be times when a single individual would be very important. I mean, my favorite example is when we raided South Africa. We had to meet Nelson Mandela. I mean, we had to talk to him. We had to understand his point of view. We knew how enormously influential he was going to be in the country's future. So when we raided that country in 1995, we had to talk to him.
What
Sometimes,
was he like?
oh, well, everything you could imagine. I mean, by far the most charismatic person I've ever met. I mean, just walking into his presence. I mean, of course, a lot is the result of what we already know about him, right? You're not walking in cold. You're walking in with certain expectations. But no, he was an extraordinary man. And he was very honest with us about the problems that the country was going to face and how he felt he was going to deal with them. And the kind of people he was putting in place to manage the economic affairs of the country. So sometimes an individual is extremely important, of course. That's the nature of history.
Let's talk about retirement for a minute. It's something Americans think about regularly. Ask yourself, how financially secure do you really feel? Do you have enough money to retire? How much is really enough? And if you don't have enough money, how can you possibly find that extra money before you do retire? These are all tough questions. My retirement software, Maxify Planner, is the powerful online planning tool that takes the guesswork out of retirement. It weighs your assets against your fixed expenses to calculate how much you can safely spend every year for the rest of your life based on when you decide to retire. And it shows you safe ways to find more money. Maxify makes a complicated problem like retirement planning simple. It's accurate, easy to use, and produces what you really seek, peace of mind. So make the smart choice and visit Maxify.com today. Don't miss this opportunity. That's Maxify with an I, Maxify, Maxify.com. Now let's get back to the podcast. Would your committee be routinely meeting with like our Treasury Secretary or head of the Office of Management and Budget or the CBO director? Any of these people show up in your office, or is that a little too close to home?
Well, here,
You have to keep
as I mentioned before, during the time I was at Moody's, the United States was kind of a non-issue.
Yeah.
I mean, it was a solid AAA. We didn't think twice much about it. There wasn't much call to go in and meet with the Treasury Secretary or the head of the Fed. That was much more the case if we went to Mexico or Argentina or, or even Russia or China. We would want to meet with those top officials. In the US, it wasn't so much the case. Now, I don't know what has happened since then. I'm not there anymore. So I don't know what goes on in those meetings. It wouldn't surprise me though that in recent years, the Moody's team and other agency teams have met with the top officials.
So let me raise something with you which concerns me about Social Security. We have some people who think long term, really try and think long term. I'm thinking about, for an example here is David Stockman. Back in I guess 82 or 3, he got the Senate to vote on a bill that you got somebody to introduce a bill that would immediately raise the early retirement age for Social Security
Right.
and save them money because Social Security was in trouble back then. And we had the Greenspan Commission. But anyway, he pushed, this was like his Stockman initiative. It got voted down 100-0. And then the next day, I'm working at the Council of Economic Advisors on loan from Yale, if you like, to Tobin's great unhappiness that I would go to Yale to work for the Reagan administration, even though I didn't vote for him. This was the end of my tenure option. I never told Tobin I never voted for Reagan, that I was trying to, I thought these guys needed help and I needed a date. So anyway, But Stockman has us into his office, including Marty Feldstein, who was kind of got me included in this meeting. And then he's really happy and smiling. He's just been defeated 100-0. And he said, what you guys don't realize, we had a lost leader here. We stuck in the taxation of Social Security benefits with no indexation of the thresholds, so it will become a bigger deal through time. So to me, that was both like bad, I didn't like that because I think people should know what's going on. And
Mhm.
but David's concern was the long-term sustainability of the country. But the Greenspan Commission then proceeds to basically operate on half the tumor, or maybe 40% of the tumor, and leave the rest for the future. And so back then, we needed about a 2 percentage point hike in the payroll tax, which is 12.4% for Social Security, up to 14.4 to get to long run fiscal sustainability in Social Security. Now, today, the most recent trustees report, we need a hike of around 5.6% percentage points. So not 2 percentage points, but something over five. So the
Mhm.
tumor is like twice, 2.5 times bigger. Uh, so this tendency to do too little too late is our tendency. This notion that we can look out 75 years. I mean, you're looking out pretty short term because you're just saying, in the next 10 years, are we going to see this particular security defaulted on? And that's the job at Moody's, that to look at, kind of oversee that security. But for the country as a whole, I see one of the big concerns is that our entire fiscal framework is so screwed up and so language driven, and so short term. Even the long term is short term. 75 years is a lot of years. A
Mhm.
lot of the 75 years that we were looking at it back in 1983 have already passed, right?
Right.
Um, and uh, 42 of those, I think. So the that's a big concern. Do you share that concern too?
Oh, absolutely. I think you're 100% right. I mean, we keep kicking the can down the road. I mean, we could do some of those things that would give us more breathing space. I mean, we could raise the retirement age further. People are living longer. People are working longer. We
Right.
could do that. We could change the way it's indexed. So it isn't indexed to wages, but is indexed to prices.
We
Um,
could raise the ceiling so the same share of wages are
right.
to FICA taxation.
Yeah, we could do a number of things that would certainly buy us time. I mean, they won't solve the what you've described as the very long-term problem, but they would buy us a number of years more
Yeah.
in which the political system could begin to, adjust more to the reality. Now, will that happen? I don't know. I mean,
Yeah. I
at
think
my age, I don't expect to see it. So
my view,
one way or the other. But I would love for my grandchildren to have a more stable and more sustainable fiscal package there than they are going to have.
yeah, just to say that I think the only way we're going to get out of our long-term fiscal problem, which is nothing that Dodge was, if you cut 20% of federal spending, uh, our fiscal gap analysis says you still have a massive problem. You still have over 100% implied tax rates on future generations if you leave it to them. It's these entitlement programs, and we need those, but we need to reform them fundamentally. We can't.
Right.
The Social Security system's like 85 years old now. It's got 22,000 pages of rules, a huge, 50, something like 60,000 people mismanaging these 22,000 pages of rules. And we just need to pay off what we owe, shut down the old system, treat everybody fairly who contributed, but put in something modern, what Bismarck would implement if he were just to arrive on Earth again and say,
Mhm.
how do we use our modern system to set up a modern Social Security system. It'd be like more of a provident fund, fully funded system with progressivity and government contributions and women and partner spouses being treated equally so that you don't have this basically sexist aspect to the system. We have like 20 highly sexist provisions in Social Security benefit. So that to me has required radical reform of Social Security, healthcare, the tax system, which is locking the poor into poverty. We have 500 different fiscal programs. Every state has their own Medicaid, their own
Right.
food stamps program there. So they have their own tax schedules. If you earn more money, you lose this benefit. And, or if if you're 63 and you earn an extra buck, suddenly at 65, your Medicare Part B premium is an extra 1,200 bucks higher.
Right.
This is
No, you're absolutely right, Larry. And we need radical reform. Absolutely. I agree with you completely. I think your suggestion for Social Security is a very good one. Other people have suggested similar schemes, but I think, can we get that? I mean, can we get radical reform of both Social Security and the healthcare system? I mean, look how hard it is to get even small things done. And look how often we go in the wrong direction.
Well, I think
Right now we're doing things, which I dislike intensely, like tariffs and mass deportations. We're doing things that are probably going to harm our economic growth, which is one of the things that could help us get out of this, is a faster rate of economic growth. We're not doing that. And we're not moving toward radical reform of these systems. And I don't have any magical answer, as to how we get there politically. I think economists are, we're good at figuring out what ought to be done. I think we know what ought to be done. I mean, I think I would, for example, very much like to see us move to a consumption tax.
Me too.
To a progressive consumption tax. I think we could replace everything with a consumption tax. It doesn't have to be a VAT, which I know people dislike intensely, but there are other ways of getting to a consumption tax. That would help us by, directing more funds toward investment and saving, and help us in general.
Most people, by the way, think a consumption tax is regressive. The Democrats are so screwed up on this.
Yeah, I know.
The Republicans would go for this. The Democrats should say, please be our guest, because if you're rich and you have to pay you're not paying payroll taxes, you're not working, you're not taking any salary. You're Elon Musk, you're not getting paid $1 a year. All your wealth, you potentially are spending a lot of it on, not a lot of it in his case, but let's take the typical billionaire. They're spending a lot on jets and tax consumption, including the imputed rent, the services from your yachts and your homes and your airplanes. They'd be in effect, being taxed on their wealth. And their kids, when they inherit, would be taxed on their wealth when they spend the money. If you're Warren Buffett and you go to the same steakhouse every year and have a small house, I sold his house in Omaha, a very small middle-class house. You don't pay much in taxes. So it's really a tax on wealth, or the use of wealth not to be invested, but to be wasted. And Congress has 535 members, not a single one has a PhD in economics.
Yeah.
They're in effect building.
That's a good summary of where the problem comes from. I mean, I think, knowledge of economics in this country is generally pretty abysmal. And that's a large part of our problem. People don't understand these issues.
Unfortunately,
our politicians have no interest in doing these things that we really need to have done.
David, unlike me, you're old enough to run for president.
No, thank you.
Let's start getting on the campaign trail.
No, if Biden was too old, which I happen to think he was, then I certainly am too.
Yeah, no, he was way too old. Listen, let me just see if you want to make a plug for any of your writing. You have this, if I recall correct, you have you post stories about financial kind of remind me if I got this wrong, financial happenings in the marketplace, financial stories about Wall Street. Am I correct?
No, that's actually I I posted a couple of stories with an old friend of mine, Doug Lucas, who has a website.
Oh yeah, that
He
was Fitch.
does, yeah, it's his website, stories.finance, as I recall.
Okay, that's
Yeah,
okay.
and there's some fascinating memoirs, memories that people have of working in finance. Now, what I have now is my Substack. I anything I want to say, I put on it. And as you mentioned, it's actually, since you mentioned me, I've gotten some more subscribers, which I thank you for. Um, it's free. I don't charge for anything. Um, and people can go to substack.com at David H. Levey if they want to subscribe to what I have to say. Yeah, I've been trying to cover, as I said, a lot on international financial monetary issues, but also the debt questions and the rating related questions. But also I have a great interest in political philosophy, so I will try to keep my eye open for interesting material on socialism, capitalism,
Right.
populism, fascism, whatever you want to talk about. Uh, and
Well, listen,
New York City, as I do, I've been very exercised by our recent election. So I have to admit that I am not a great fan of Mr. Mamdani, and I have posted a number of things about his program, which
yeah.
I don't think moves the city in a very good would move the city in a very good direction.
Yeah, another case of somebody with good intentions but no real training, who's probably going to get the poor to pay for the poor.
Yeah, well,
Yeah,
as
that's
you just used the key phrase. I mean, a lot of people judge politics on the basis of intentions, but we know that how the road to hell is paved, and the intentions just won't do it. People don't analyze, they don't correctly analyze the consequences of what's being proposed.
yeah,
That's more difficult. I mean, I understand it's not easy to do this. We economists get it wrong sometimes, obviously. We don't agree with each other
yeah.
frequently. So it's very difficult for the general public to correctly analyze the consequences of these proposals.
So just for, for people that want to take a look at my specific views about how to fix the country, there's a book that's free at kotlikoff.net, just my last name.net. It's called You're Hired. And I actually ran as a write-in candidate in 2016 against Clinton and Trump. Uh, I was registered. I was one of five people that could have been elected, but I ran to write this platform, which I turned into a book the next day, basically after the election. And it's called You're Hired. It's not called You're Fired, but it talks, they're like 11 bullets for fixing each of these programs. It's not hard. And taxation is one of the proposals. It's also super simple to do. So um, there is hope
Yeah.
that we can get some good economics down the road. David, thank you so much. I hope to have you back. Keep putting out this great Substack column, and thanks for you've played an incredibly important role in developing sovereign debt rating for the country and for the world. And I'm grateful as an economist. We certainly we economists use and look and take uh, ratings of countries' positions, debt positions very seriously, and all of Wall Street does. So you made a huge contribution in your career. So thank you, and thanks for coming on.
Well, thank you for having me, Larry. It was a great pleasure. Really enjoyed it.
Thank you.
Bye-bye.